Welcome to the MHP Exchange, where the riches are in the niches. We'll show you how to invest your way into mobile home parks with real strategies, tips, and behind-the-scenes know-how to grow your cash flow. Stick around. This is where smart investing begins.
Welcome back to another episode of the MHP Exchange podcast. Frank Rizzo here with you today. And today we're going to really talk about the subject, especially with a lot of newer or younger real estate investors coming into this space. And are we really raising a generation of real estate investors, or are we really raising a generation of real estate influencers? And for some perspective, and not to date myself, but when I first got into the real estate industry at 19 years old, I was a unicorn. It was a middle-aged business. And from the real estate sales side, right, I came in from the brokerage side. It was typically retirees, divorcees, people who were doing it part-time, and that has completely changed. And anybody out there who's following anything on social media, we've all seen the stories of 20-year-old, 23-year-olds raising capital for these big deals, which was never a thing before. We've seen a surge of all these different asset classes. And the question is, is this booming because real estate now is seen as an opportunity, or is it social media clout? And we're talking today with Professor Mallory Meehan, who's an educator at University of Pennsylvania, and she is
No, I'm a Penn State University.
Penn
Sorry, we
State.
have to clarify
I'm
that.
sorry, Penn State. I take that back. I take that back, Mallory. But she's also the founder of Inspire Wealth Education, and she's an author. So, and I thought she'd be, as a mentor, as a coach, she's probably the best person to talk about this subject. Mallory, welcome to the program. How are you today?
Thanks, Frank. I'm doing great.
So Mallory, just so anybody who's not familiarized with you or hasn't taken one of your classes or read your book, if you want to give everybody just a little bit of your background and how you got to where you are today.
Yeah, absolutely. So again, thanks for having me. I am Mallory Meehan. I am a professor of real estate at Penn State University. I've been teaching here now for almost 10 years. I have created courses. I teach the undergrad and graduate different level courses on real estate investing, understanding risk analysis. I'm an attorney by trade, and so I bring in a lot of the legal and regulatory background to the way that I teach. And over teaching the past decade, I've seen that real estate education just isn't available to the public. Now, like we were talking uh, social media is available, but you really need to ensure that the people you're talking to or listening to are credible. And so, what I wanted to do is to create an actual course that people could actually rely on for authority to understand exactly what is happening in the real estate markets. And so, I've created an online course that anybody can take. And with that, I've also created a book on teaching people exactly how to invest in real estate, how to look at real estate, and really help people understand it in plain words.
It's, and we've seen, Mallory, that there's like the entry age of real estate has been a lot earlier, and it's gotten a larger segment of the population. Now, from my perspective, I always thought, real estate is the great equalizer, right? The fact is it's self-taught. There was no barriers to entry, and the definition of your success was really the amount of work, energy, and effort you were willing to put into that. But we're seeing people enter into the space a lot earlier with a lot less business experience. Is it that we have more people or young people who are entrepreneurial? Is it that, or is it more that younger people are not seeing a pathway for success anywhere else? Like, where do you see that from your position of really dealing with younger entrants into into the space? Like, where are you seeing that fall in, or that interest level come from?
Yeah, so I think a big part of what really increased the interest in the younger population was HGTV. And so with HGTV kind of exploding over the past, let's say, 10 years, people were able to see post crash of the 2007, 2008, people getting in and doing these fix and flips and making big money. And so I think that was kind of the start of getting younger people interested and seeing how it was possible. Hey, you just call on mom and dad, the bank, and find other people who have money to help get into this space. And from there, we saw social media explode over the past decade too. So we're seeing a lot more information about real estate available than we've ever had before. And so I think that that was really kind of like the integrated part of getting younger people into real estate.
But do you think that creates a false perception of what it takes to be successful? Like
100%.
we've all watched those HGTV shows, and they do a complete house renovation within 7 days, getting ready for an open house. I will tell you from specking 300 houses in my career, that never happens. Like, you cannot do a full gut renovation inside of 7 days, get permitting, approvals, and worried about an open house. Like, that's just not reality. But does that set a false expectation in a lot of, let's call them impressionable minds of, hey, this is what it's going to be successful. You're going to find the house, you're going to flip it, and it's going to be so simple, easy because you saw it on TV, or you just saw somebody post their latest win.
Yeah, 100%. And that's exactly why the foundation of education is so important. And that's the reason why I created my course. That's the reason why I continue teaching at the collegiate level, is for people to understand that real estate, while it is a great investment, you have to be educated on the process behind what's going to set you up for success. And, right now in our country, we've seen some of the highest debt levels that we've ever seen. And, I attribute a lot of that to people taking risks because they've seen these things happen where they're not seeing the fails that people have made. They're only seeing the upside. And understanding the risks that go into this is so important so you can help mitigate them and prepare for what happens if you have to foreclose. What happens if a tenant leaves and now you have all of these costs that you weren't expecting? So all of those things together, I think, have created almost a perfect storm as to why we're seeing people get into real estate, but we're not seeing the failures, but we're seeing it on a different part. It's the credit card debt. It's the, you know, not being able to afford their first home, other things like that that have all kind of contributed to this factor.
What do you see as the, and I say this, and I'm going to ask this question because I used to teach the real estate sales course, right? What do you see as the dropout rate from people who get into uh, real estate, whether it's one of your courses or courses at college, and they think that it's an easy path to make money, right? And when you sit there and you talk to people, by far and away, I would ask people, why are you here? I was like, oh, I want to make money. I think it's an easy way to make money. I've seen somebody else do it. My cousin who does real estate, and he's a nitwit. He makes money, right? Like that. But uh, how many people do you see that would fail, or kind of just say, hey, this isn't for me? Like, how many people actually drop out, and how many people actually stick with it?
I think that's a great question. And what I always encourage young people to do is to find a mentor first and to watch somebody else do it and, be a part of a team. Instead of going out on your own for your first deal, I think it's always better to somehow form a partnership. And so, for those people who form a partnership or find a mentor that's able to take them under their wing, the success rate is obviously a lot higher. For those people who are going out and trying it themselves, I would say the success rate is fairly low, and usually once they get that first deal, it burns and they never get back into real estate.
That's such a great point that so many people skip. That if you have somebody that you shadow for a while, and I used to tell people that the the highest ROI you'll have is take somebody who's in the position you want, take them to lunch and find out what they did. And then I'm using this phrase from somebody else, but you take the best and you leave the rest, right? So what you take what they said that works for you, you see what they did and you try to model it as much as you can and then you put your own little flavor to it. But they've already been successful doing that and if you follow that path, your chances of success are that much greater. So it takes a little bit longer, but you it's not about getting rich quick. It's about building wealth slowly. And if you take that approach, your chances of success or sticking with it are just that much greater.
Yeah,
Now,
1,000%.
right, and I think that's such a key point to it. Now, one of the key components of what you teach, right? Or which one of the things that you kind of and you actually do this yourself, which is great because you're not just somebody in academia saying, "Hey, this works," but it's creative financing and creative strategies to do this because obviously if you're starting out you probably don't have a ton of capital to go to work with so you have to be a little bit more creative. um, let's dig into a little bit of that because I know you just did a creative. You were telling me about a creative deal that you just closed. If you want to just kind of break that down a little bit and how you structured it and what that deal looked like.
Yeah, absolutely. So I think creative financing is probably the easiest way for younger people to get into real estate. And it's going to be understanding why the person is needing to sell. And so that's first and foremost. We see listings and if there's a realtor listed, you obviously know they have some level of motivation, but you don't understand to what level they have. And so I had a property that I came across, and it was actually a for sale by owner. And those are typically the ones that I like to focus on first is the ones who are for sale by owner. They want to save money because they don't want to involve a realtor. And so if you can help save them money or make them more money, then that's usually the path that they're looking to go. And you don't have to worry about the third party realtor, interjecting or
And one thing I found, and I'm saying this as somebody who's been a realtor for years. Many realtors, even though they're real estate professionals, they do not understand creative financing. And when you go to them with something like that, or their initial was my seller's not going to take this because ultimately they're thinking they're not going to get compensated
paid.
and or paid. And if they don't think that deal is going to work, it's something that they're going to almost become a you either have to educate them on why it could work, why it could work, and it's a benefit, or how it can help them in a different strategy. But they might be the roadblock or the obstacle. So the for sale by owner, you have that direct access to. So that's a great point. So
Yeah, 100%. So I found this property. It's in my neighboring town of Belfont, which is adjacent to State College, where the university is located. And it was a second home for someone. And so he was using it only on a part time basis, and he was actually moving away. So it was getting harder for him to get to this property and actually utilize it. And so, I talked with him as to, what are you looking for? He's like, look, I have a mortgage payment on this. I am not getting to this property. I'm losing money every month and I just want to get out of it. And so, for a lot of people, they're not necessarily even looking to make money. They're just looking to not lose money. And so, that's a good strategy, especially for creative. If you can find the people that are just looking to cut their losses before even making money, this strategy works. And so, what I did was I told him, I said, okay, well, what are you hoping to get? What is your bottom line number that you're hoping to get for this property? And, I'll be a little more flexible with that purchase price because it's not necessarily about the purchase price. It's about how much is it going to cost me monthly. And then we'll talk about, getting to that purchase price. And so he gave me a number and it was comparable to the properties that have been selling in that market. And so I told him, I said, look, if we come to the table and I take over all of your payments, so you keep your loan in place because he had a 3% mortgage, which we know we're probably not seeing rates that low. I looked at his rate, I looked at his payment, and I looked at what I could potentially rent it for. And there was definitely an upside. And I told him, I said, look, I'll take over your payments immediately. You won't have that money out of your pocket. We'll come to the table. I'll give you $5,000 in your equity up front. And then every year, I'll pay you an additional $5,000 from the date of our closing. And so we closed in May. I paid him $5,000, plus we both split the closing cost. And then every year I've paid him $5,000. I'll pay him $5,000. And then after 3 years, he'll cash out the rest of his equity. And so at that point, I can determine what I want to do with the property. Do I want to keep it? Do I want to refinance it? What does that strategy look like for me? Because the market can change in 3 years, but I've built in that time. And so what I chose to do with that property, because he actually sold it to me fully furnished, was to turn it into a short-term rental. He didn't need the furniture because, again, it was his second home, so we incorporated that part into the strategy, and so for me, already having short-term rentals made a lot of sense. I was making over double what I was paying in the mortgage rate on the short-term rental side, and so it definitely was a good strategy. Now, as time evolved, I became pregnant and a lot of other things changed. I decided to change my strategy and I converted it to a long-term rental. That property is still cash flowing almost $1,000 a month.
Wow. And what I love about this story, because it doesn't matter the asset class that you're in,
Mhm,
how you started this. So while my focus might be in the manufactured housing space and looking at opportunities that way, the the structure of how you approach this deal from the first point is when you have that conversation with the seller, you're qualifying their needs first, not, here's my offer, take it or leave it, right? Because that then it becomes transactional, and people forget real estate, whether it's residential or commercial. It's a lot of it is relationship driven, and the way you find those opportunities is cultivating that relationship with the person on the other, who's technically on the other side of the table, but both of you guys are trying to get to the same location, right? We're trying to get to the same spot, but if I can identify your needs, your wants, your desires, your motivations, and I can hit those buckets, then I have a better opportunity of creating a structure that works for me. Or and in your case, it's, hey, listen, you have a great mortgage. I can't get rid of it because I can't replace it. And if I had to, I'd probably have to offer you less, but I can hit your number, but you're just gonna hold. I'm gonna maintain this. I'm gonna manage it. It's gonna be off your plate, and now you have essentially an option of what you want to do inside the next 3 years, right? You have
mhm.
you could sell it, you could refinance it. There's probably a multitude of things that you could do, and create some additional value for yourself. So it's a great strategy if you know how to do that. Now, when you come to a strategy like that, right? And I know this. Now I'm going to ask you to put your lawyer hat on. Like, what are some of the risks that you would have to insure? So if somebody's out there listening, they're not just saying, "Okay, great, I'm going to assume somebody else's mortgage and I'm going to make that payment." Like, how did you protect your downside risks, or protect yourself from the seller doing something that maybe sells, maybe the owner sells it to somebody else while you're in contract? Like, how did you, because he's still on the mortgage technically, how did you protect yourself that way?
Yeah, no, that's a great point, and I think that people need to understand is that you have to create that relationship building up front, because not everybody is going to trust you. They're not going to trust that you're going to actually pay the mortgage, pay it on time, and it's not going to affect their credit rating. And so what I had done was, one, people have to understand that the mortgage and the deed are two separate legal documents. And so we changed the deed at the time of closing. So the mortgage stayed intact while the deed, the ownership, transferred to me. So I have full ownership of the property. What I did was I contacted the mortgage company and told them that I have the authority of the mortgagee to make payments and to make changes, tax information, insurance information, had the seller sign off on that. Then what I did was I made myself the primary contact for anything related to the mortgage. So I kind of told them that I am the manager of the property, if you will, because sometimes banks get a little bit funny if they see somebody else coming in and wondering, why are we talking to this person where this other person's name is on the mortgage? And so you do have to kind of walk that fine line because you don't want the bank to call the mortgage due if they have a due on sale clause. And that was something that I didn't want to have happen because obviously the property had sold and I was still retaining the former mortgage in place. And so you have to be careful with that. Now, I also carried my own insurance. So the insurance policy was covering the mortgagee, so the seller, but I was listed as the secondary insured. And so I covered all of my bases on the insurance side, and that was fine. And that's exactly what the bank wanted to see. They wanted to see the primary mortgage holder as the first position and then myself as second position. And then you just want to make sure that at closing, everything is properly recorded. I also recorded a secondary note. So the note was for the equity that I was going to be paying my seller to ensure him that I wasn't just not going to pay. That was all recorded and is all on public record so that anybody could search. And he technically has a lien against the property for his equity until it's paid off.
And that in doing that, you get out of the cloud that the seller may have. And we've closed a lot of creative financing deals or creative structures, whether that it's involved with the building I'm in now. We did a lease option with the former owner where we came in and we did the renovations to the building. We struck a price, and then by the time we were done, the equity that we built on the renovations allowed us to acquire it. A lot of times we'll do some sort of seller financing or holdback, and you doing it over time, you build more credibility, but also in explaining it to seller, how here's how we secure your money. Here's why it's a benefit for you, right? And here's what by following these steps, you can get what you want and you could be protected to know that it's going to happen. And I think that's huge steps you're taking. And sometimes people don't see that in a quick social media post of like, look at my big win without knowing those steps. And that's why taking that extra step and going through that training or sitting with a mentor who's done that before becomes so crucial to that. Now, and I did want to touch on this because I know um, you were more focused on short-term rentals. Are you pivoting out of that? Is there something, or is there a reason, or because I know that was the very uh, it was a very on trend thing to do for a while. Like I think coming out of COVID, I know a lot of people who said, "Hey, I'm gonna buy this. It's a short term rental," and they were paying some maybe inflated prices on some assets because they thought it was in a great area and they would rent it. But you've kind of pivoted a little bit. What has made you do that?
Yeah. And I think short-term rentals can still work, and it depends on the location in which you're at. I pivoted my properties, one, because there was a lot of regulation changes. You were seeing a lot of local municipalities and a lot of townships actually putting restrictions into their zoning and into their permitting where it had to be owner occupied in order for it to be allowed to be a short term rental. They've now added that you have to have a short term rental license in order to operate. And my properties were all investment properties. So I couldn't show that they were owner occupied. And because of that regulation, I did have to pivot. Um, Now, that being said, there are creative ways that people have gotten around that you could find somebody who's willing to long-term rent it from you per se, and then you could short-term rental it from there because that's typically a requirement. Either it has to be a long-term rental or it has to be a owner-occupied property. And that's why I tell people if you're thinking short-term rentals, or really if you're thinking any investment strategy, one of the first steps that you have to take is understanding the local zoning and the local code. And if you don't know that, your investment strategy can be completely derailed before it even starts. I do a lot of advising with people who are evaluating short term, even if it's for their home, like they're thinking they may put their home on. even that can potentially not be the best use of their time or money. And so I think it's really important for people to understand first step, you have to understand what's happening in your local market.
I think that's so critical because you do see certain municipalities changing it rules and regulations on it, where you might need a 30-day stay. And then all of a sudden, once you get to 30 days, then all of a sudden the rights of the tenant become something different and your investment could be something different. And if you think that you could run this or isolated and those rules won't, it's all fine until something happens. And then all of a sudden, when something happens, you have a real issue on your hands, then it becomes something you have to deal with. So it's better from the beginning to know what those risks are and be able to assess them to make sure that you're being compliant in the areas that you need to be compliant on. And going back, Mallory, because I know you obviously have your finger on the pulse of newer people coming into the business or coming into the space or wanting to be a real estate entrepreneur. You know, do, are they chasing is it a narrative that they're chasing, you think? Are they chasing net worth? Are they looking at this as, hey, are they looking at this as, hey, I'm going to build wealth here. I just want to create a cash flow stream. And I understand that it's going to take some time and be diligent on this. Or is it more of, hey, I think I could come in here and get these big hits right away. And I'm going to be this influencer raising capital. Like, are they building to scale or to stabilize?
So the young people that I typically see, because they're taking the step to get educated, a lot of them want to use real estate as kind of like a side hustle. They want to have a career in maybe something else, but they want to use real estate as an equity building opportunity. And they see that you can actually make money, but it takes time, which is a really important thing for people to understand. And so, one of the first things that I typically tell young people is the easiest way to get into real estate is by doing house hacking. And you're going to have a place to live. Can you find a place that maybe your parents can give you a down payment for? And then you have roommates to help you cover a mortgage. Best way to see how property management works, how ownership works, how leasing structures work is by actually doing it and being it day in and day out. And, a lot of people look at duplexes. Can I live in one side and rent out the other? But, here in college town, find a house where you have 3 roommates because guess what? You're gonna have roommates anyway, so you might as well find people you want to live with and have them pay your mortgage and you build equity while you're in school. And I tell people that's one of the best ways of getting into real estate. And then when you graduate, you can decide what you wanna do with it. Do you sell it? Do you keep renting it out? Do you need another place to live? Can you use the equity you've built to pay your down payment on another place? And now you're scaling, but you're scaling in a responsible manner and understanding what's happening at that point in time.
Yeah, that's a great point, and it's an easy entry point to do that. So is that your number one task? Like, hey, first thing we're going to teach you to house hack. See if your mom or dad can give you a down payment on a home in that college town. I mean, is that your number one? Uh, uh, And
I
if
don't
they
wanna say
don't,
it's
and
number
if they
1,
don't,
but I think it's a great easy way to get
yeah.
into the investment strategy.
Got it. And that is a great entryway. And even if, now as you're talking, even if, let's say your parents didn't have the down payment money, hey, sign the lease, commit to the lease, and then sublet the rooms at a higher number. You could even create some additional cash flow or offset your living costs completely by using some of those strategies. But to your point, it's now applying some of the knowledge that you're going to teach you and doing it and realizing that, hey, it's not going to be perfect, you're going to make some mistakes, you're going to do this, but at least that gives you the skill set and the knowledge to move forward with it and find out what works and what doesn't work. Where do you see the biggest the biggest risk for these newer entrants when you're training somebody or they're going through a program? Where do you see their biggest risk or their biggest blind spot to, you know, to real estate?
I think the underwriting process is probably the biggest risk when they're looking at something because a lot of them have tunnel vision and they're assuming that what is happening today will continue to happen. And, to the point of my short term rentals, I underwrote a property assuming what I was going to get on a short-term rental basis, which obviously is a higher market cap than what I was getting on a long-term basis. And so because my strategy had to change, my underwriting now had to look a little bit different. And so many people are going to underestimate their repair costs, their, monthly expenses, and they're going to overestimate what their cash flow is going to be. And so it's about creating the most conservative model that you possibly can to know that this is worst case scenario and that is those are the numbers that you should be using when you're evaluating it. Everybody wants to look at the upside. They want to look optimistic, but by doing so, you're hurting yourself because you don't know what's happening. I mean, here in the Northeast, we've had temperatures that have been below zero for multiple days. People's utility bills are higher than they've ever been. If you're a landlord and you cover those utility bills for places in this area, you probably didn't budget for an $800 a month gas bill. That's what's happening. And so that can really affect the bottom line. And especially if you're not creating reserves, you're kind of just taking those cash flows and utilizing them on your, part of your income, you're going to be stuck.
So the only thing I'm going to add to what you said, I don't think the underwriting issue is just a new real estate investor, because I've seen a lot of you see a lot of opportunities or decks that come across your desk, and I think people always want to look at the upside. There's a confirmation bias. You want to do a deal, right? It's exciting. So you see a property, you want to do a deal, but to your point, it's all the things that you don't expect to happen. Like rents aren't, and we've seen it in multiple markets right now where rents have plateaued, right, or declined
Mhm.
in multifamily, right? There's sometimes there's the elasticity of your resident or your customers that just they can't go up any further, so you can't project 5% rent increases every year. It's just not going to happen. They're going to hit a point and it's going to slow down. Expenses, they're not going up the way they did, but to your point, they're still there. They're stuck at higher levels, and try to get in some of these markets. You getting skilled labor is expensive. The trades we don't. I read a report for every, or I was at a conference where they said for every six tradesmen they have in this area, every six tradesmen they have leaving the business, they have one coming in. So think about
Yeah.
that. So if you're, a licensed electrician, plumber, HVAC mechanic, there's six people leaving for one person coming in. Those prices, though, that cost is only going to increase over time because getting somebody to the site is going to cost you more. And you're not, as the owner, you're not going to have the ability to negotiate better deals. You're going to be stuck at those prices, or you're going to wait in line, right? Because they're
Mhm.
busy.
Yeah. And if you're smart, you're going to find those people and you're going to retain them. So you're going to want to pay their prices because you never know when you're going to need them. And that's one of the
Uh,
biggest parts too is, you have an issue and you only have so much time to address that issue. You need somebody who you're able to account for and, you got to pay them.
So what's the strategy you're looking at now? I mean, are you market specific? Are you just more deal specific where, all right, if I could find a deal that fits my structure, that's great, and I'll make it work? Do you look at, is it college towns? You're looking for area markets that have accelerant? Like where do you find the best value for yourself, or where do you kind of counsel people on where to look for value?
Yeah, I think that, especially people that are just starting out, one of the first things that I tell them is that you really need to understand the market that you're entering. And so the best first market is typically the market that you're living in because you can see what's happening on a daily basis. If you're choosing to go outside of your current market, you need to make sure that you find a reliable source that truly has their hand on what is happening in that market. And so a lot of people want to find a vacation property. Maybe it's a place they typically vacation with and they understand what's happening. They like the market, but you have to have someone local who really understands what's happening. To my point earlier about the local regulations and the changes, if they know that something's about to change, but you don't know that, you're going to be, one step behind. And so the markets that I'm typically looking at are markets that I'm familiar with or that I have relationships with who I know are also very familiar with those markets. And I'm looking at secondary markets a lot. And these are places where working classes wanting to live or needing to live but can't afford to buy. And so those are typically the best areas trying to get the highest rent value with still a low point of entry.
And I think defining that market is so critical especially if you're looking in different markets. Like for us, in one of the things we try to define exactly where we could be successful. And I think we have enough data points where we know the markets where we could be successful and the markets and what has to happen in that market and what has to happen in a different market, right? So we have enough data points to know if we're in a market that has to do infill, which means we're bringing in homes to fill in lots, the median sale price of a traditional house has to be, somewhere between, 225 to 250. If it's in that range and offering new homes between 60 and $80,000, I'm going to be able to infill. If the median sale price of a home is 150, I have to have a community that's all filled up, right? So I can define what data points where we can be successful and what strategy could work in there. And I like that you're looking at secondary and tertiary markets because there's real value in that, right? You could find value and cash flow from it. Like, you don't, I think too many people look for the trend, right? Like, oh, this is going to happen here and that's going to spike prices. Well, I've seen that sometimes that doesn't happen, or sometimes the impact is minimal, right? Because it doesn't kind of, spread out bec- because maybe it becomes an isolated community and it doesn't spread out to the rest. So that's a bad reason to buy. But if you're buying on value,
Mhm.
that's inherent. If something else happens, great, right? The appreciation is the icing on the cake, but the value is there, right? And knowing the levers you could pull to create the value inside the asset. I mean, is that basic of what you're teaching as well?
Yeah, 100%. And I tell people that you have to develop your own buy box because looking at what somebody else did and their strategy isn't going to always work for you. You have to understand the level of risk that you want to get into, the level of involvement that you want, the level of equity that you plan on putting out to actually get into it. And so that buy box portion is, a really crucial step, and also doing your homework on once you have identified that buy box, what's happening in that market. Because you have to, again, have your finger on that local area. You have to understand what are the trends, what's the employment, what is the average income, what can people afford to pay in rent, and is this a more of a rental market or is this more of a market? And those are really important considerations to make before pulling that trigger.
So what is someone's listening to this and they haven't bought, they're waiting to get into real estate, or they're looking to get into real estate. They've listened to a bunch of, podcasts. They've found information online that, there's a ton of information you could find online right now. Just it they haven't put it together. What's the number one tip you would give them today? Like, what would you tell them to get started other than call you, right? After calling you, right?
Yeah. Hey, you take my course then. Yeah. No, I think people just need to have clarity, and they need to have the clarity as to what is going to work for them. There's so many different strategies that you can deploy in real estate, but it's understanding where you are currently and understanding that that strategy could potentially change. I was in short-term rentals, but that was only when I had one kid. And now that I have two kids, my life has changed. And so as life cycles change, your investment strategy can change too, but you want to ensure that that can continue operating. And so, we look at, if one strategy changes, do you need to sell? Can you pivot? And so the best advice I would say is to educate yourself educate yourself and to truly look at what is going to work for you specifically, not what has worked for your neighbor, not what has worked for this guru who's showing you how they made all this money, but really looking at what are your goals, what are you comfortable with, and how can you make that happen.
Mallory, that a lot of information here. If someone wanted to get more information from you, if they wanted to find out about your course, or they wanted to find out about your book, where would they reach you? What's the best point for them to contact you or Inspire Wealth Education?
Yeah, so my website is the best place to start, and that's inspirewealthmgt.com. And they can find all of the information I post, free information, free downloads for people. They can get information on my course, on the book. I do webinars every now and again on different topics. I just did one on short term rentals. And so all of that can be found on the website directly, or they can follow me, Mallory Meehan. And Inspire Wealth on all major platforms: LinkedIn, Facebook, Instagram. Send me a private message. I'm happy to talk to anybody.
Well, great, and thank you for that. And we're gonna put contacts for Mallory in the show notes. So if anybody wants more information, uh, and to really get somebody who's not just teaching it but actually doing it, you could reach out and speak to Mallory. And I appreciate you being here. And again, listening to this program, it's not about there's anything wrong about being young. It's that's great. It's about have understanding the work that has to be put into it. It's about it's about understanding that the durability of real estate and the longevity that needs to happen for success. Don't get caught up in what you might see as social media hype, but build the look at this as not, and we said it before, is not get rich quick, but it's building wealth slowly. And that becomes durable. That's what sticks. And that's what we want to see happening to everybody who's listening to this podcast and beyond. Thank you again for being part of this, Mallory. And for those of you
Yes.
listening, I have one question for you. Would you help someone you don't know find, fund, or operate the next real estate investment? And if that answer is yes, then I'm going to ask you to leave us a rating on the streaming platform that you're listening to this program on. And if you send it to the mhpexchange.com, I'm going to send you a free copy of our after site visit report. It's the same report that our team members use when they do their site visit to ensure that our business plan is being executed and the assets performing the way it is. It keeps everything in line, make sure the business plan is following through and we're creating value. And that's our gift for you if you give us a rating on one of the streaming platforms that you're listening to below. It's how we get to other people. So till next time, everyone, this is Frank Rizzo from the MHP Exchange podcast. Happy investing.